Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Upstart Chief Compliance Officer, Annie Delgado. Now, as Upstart has been at the forefront of applying AI to lending, Annie has been at the forefront of applying regulations to AI in lending and figuring out how to interact with regulators, how to think about questions like fairness and bias, how to compare an AI-powered future with current status quo. And so it's a really thoughtful conversation about how to think about the problems we're trying to solve with the application of these kinds of techniques to the lending ecosystem, why that matters, what the critical questions are, and how lenders and fintech companies can engage with regulators to help drive forward the state of the industry so we can actually unlock more and better price credit for the American consumer and more safety and soundness for the American financial system. So she's thought long and hard about these problems, and it's a really fun chance to dive into them with her. So please enjoy this conversation with Annie Delgado. Annie, welcome to the podcast. Thanks so much for making the time to join us.
Thank you for inviting me. I'm excited to be here.
I know I've been looking forward to this one. We have lots of animated conversations that are not recorded, so I figured it'd be fun to have one on the record, if that's the right phrase.
I know, pressure is on.
No pressure. But I've been starting all my podcast interviews now with this question about how people got into banking, and you've been in the finance space longer than many of us here at Upstart. So give me a little bit of your history and how you wound up both in the financial services industry and then at some crazy fintech company.
Yeah, absolutely. So believe it or not, I did not, go to bed as a kindergartner dreaming of becoming a compliance officer. I sort of found my way into it. I did actually spend a number of years dreaming of becoming a lawyer. And what happened was that I finished my sort of undergrad career right around the time of the beginning of the financial crisis back in 2007, 2008. And I had the value of having friends who were a few years ahead of me in high school, kind of moving home around that time, having finished law school and saying, oh my goodness, we're sitting here with loads of student debt and it's hard for us to actually find that first job as a lawyer right now. And so the risk-minded side of me, who was always a little bit, good at risk assessing and deciding what was a good choice or not for the next steps for me, decided I better work for a few years and make sure that I really want to go to law school if I'm going to do that versus taking some other path in life. And so I ended up, because the labor market then, of course, turned a little bit negative, I ended up casting an extremely wide net in terms of what I would do for my first job. And I ended up getting a job as a QA analyst at a mortgage company. And it was, let me tell you, a really exciting time to work in mortgage right around that time, because not only had the meltdown sort of just been unvolving right in front of my eyes, but also we started to get a lot of new regulation coming out with GFE 2010. The CFPB got formed, Dodd-Frank happened. And so it was sort of this extremely exciting space. And I found, a niche for myself in terms of passion for public policy, particularly as it relates to financial services, and ended up deciding to stay in financial services and really to stay in the compliance space within financial services. And so that's why I've built my career in that.
Love it. You were like the fourth person to tell me they were going to become a lawyer and then ended up in the banking space. I sense a trend coming. I don't know what it is. It's the better alternative backup to something closely related, I guess. So the thing I think that makes the most sense for us to talk about is kind of the regulatory landscape, AI and lending. There's lots of topics there, but the one I wanted to start with first was kind of thinking through why it matters. Like, to me, there's this question of how do we get the regulators comfortable? What are the measurements? Yada, yada, yada. But there's a question like, should you be doing it in the first place? And what problem are you trying to solve by throwing AI at it? And so I kind of wanted to start there because I feel like without that, there's kind of like, why are we going through the rest of this if there's not a problem to solve? So what is the problem to solve, and how do you see the upside of applying something like AI? Like, what's the reason to do that?
Yeah, absolutely. And I think that is the right question to ask. Anytime you're trying to change the status quo or innovate, you better make sure you're actually doing that for a reason. And if you have a really finely tuned system that's working really well, there's no real reason to do that. But I would argue, and I think it's maybe not discussed enough, that our system today has way too much inefficiency and way too many people are left out of the system. And I think that it's just something that's not discussed publicly enough, the sort of breakdown in terms of access to credit that we have in the United States, where we have a large population of people who would be really good bank customers, bank borrowers, who are instead declined for a loan because banks aren't exactly sure how to underwrite the risk associated with that particular application. And so Upstart did a study on this a few years back. We found that something like 40% of people have access to what we would call prime credit, but 80% of people have never defaulted on a loan. And that tells you that there is a huge opportunity in terms of people who should be qualifying for loans who are not qualifying for loans. And then there's an even sort of bigger population who aren't even measured by that study, who are what we call the credit invisibles, who either maybe don't have a credit score, they're recent immigrants, they're just building their credit history, et cetera. And so the opportunity to sort of have a more efficient system that's more inclusive for people is vast, and it really needs to be solved, because most of us are not in a situation where we just have unlimited funds at our fingertips whenever we need them. We actually need to borrow money for things like cars to drive to work, or to go to college, or to go to law school if we want to. Most of us don't have the money sitting around to do that. We have to borrow it. And so if you have a system where only half the people are able to borrow it, that's a broken system, because everybody should be able to have access to that money so that they can achieve their dreams. And that's really the problem that we're trying to solve by unlocking some of these innovations like AI and lending.
Yeah, I think it's such a critical point. And sometimes I think people wonder if credit really matters, if we should make credit more accessible or not. And I think it's so easy to get lost in that, that question versus the reality that, like, access to opportunity and mobility is really, in many cases, for many people, gated by access to credit. And so credit is not just credit; it's your ability to participate fully in kind of the American dream and the opportunity.
Yeah, that's exactly right. It's the path to home ownership. It's the path to employment for a lot of people. It's the path to sometimes paying for, the healthcare that you need so that you can stay healthy to do those things and provide for your family. It's the access to going to college. It's really beyond just credit. It's really building your future. And that's why it's a problem we got to solve.
So one question maybe that comes up, and you may not have a perfect answer here, but I'm just curious your thoughts, is how has this not been a problem? Like, why is it a problem that's not addressed, that's spoken quietly, that's not something we focus on? And, it's interesting to me that as a math kind of person, I look at that inefficiency. That's a huge problem. And yet for many in the financial industry, it doesn't seem like a huge problem. And I'm curious why you think, what that disconnect is between that opportunity you see and the kind of sense of there's a problem here and something we're talking about that doesn't feel as urgent to me in the industry writ large as it does to maybe you or
I. Well, I don't have a perfect answer. That's true. I think that hard problems are hard to talk about. And so a lot of times when you have things that are really hard problems, people would prefer not to talk about them. And I think that there is sometimes a disconnect between who the problem is facing and, the sort of business needs on the other end. So in the banking industry, if you aren't lending to everybody, but the people you are lending to are paying back and your business model is sound, et cetera, you maybe don't have as big of a concern about the people that you haven't been lending to. But as a society, we should be really concerned about that, right? Because there's, some of the problems that we just sort of were talking about in terms of, what the people left out of the system are truly getting left out of. And so I think there's sometimes just a disconnect there. And again, I think the underlying problem, like I said, is it's a hard problem. It's a hard problem to solve. It's a hard problem to talk about. And it's just something that, in my opinion, should be brought more to the forefront of conversations. So
when you say at the societal level, that feels like something government, regulators, policymakers should care about, right? Like, I can totally understand if you're a lender and you go, hey, I make the loans I need from my business point of view, the volume is right, the risk tolerance is right, the losses are right. Like, my business is working as it should, but maybe at a government or a policy level, I go, hey, we got people who aren't accessing credit. That's a problem. Have you found, we can talk about kind of other topics of government engagement later, but I'm curious if you see the focus on that from regulators, the sense that, like, hey, we do have a need in terms of access to, and of course, the other side of the coin from access to is the cost of credit, because both of those are really related to inaccuracy in the system. Is that something you see regulators, policymakers interested in, focused on, as something they want to see their influence and kind of direction solved within the industry?
I definitely think that there is a focus on it and there's conversation around it. From a policy standpoint, it's much harder problem to solve because you don't need to only be worried about the access. You also need to be worried about the consumer protection aspect of making sure, right? You can easily solve access to credit by giving everybody a loan, but then you've caused this other problem of putting people in loans that they can't afford, right? Which is a predatory issue. And so I think it's just an incredibly complex topic. And so the regulators and policymakers have to be looking at it from all of those different angles and sort of striking the balance and having all those conversations simultaneously, which frankly is what fintechs and bankers have to do as well. All of us have to be sort of simultaneously worried about all sides of that problem.
So you're not an AI expert. Well, you're somewhat of an AI expert, but like I've talked to, Paul and others in the space about how AI works. So I'm going to, for the purposes of this conversation, let's take it as a given that some form of advanced analytics can help bridge that gap between that, less than half and that 80% that you're talking about. 'Cause I don't think we need to dive into how that's done or the results we've seen there. But assuming that's true, assuming, some sort of advanced analytics, machine learning can solve some of this problem you're talking about, what are the concerns that have been raised about, is it being done fairly equitably within the state of regulation? Like, give me a sense of the landscape of concern. Someone who says, hey, I've got a better mousetrap. It's doing the job. What are the things I have to be thinking about, concerned about, measuring, monitoring to make sure I'm doing it in a way that's within the bounds of the law?
Yeah, absolutely. Well, and as you mentioned, I am not an AI person. I'm a financial services person and a legal regulatory person. But having been at Upstart for the last 7 years,
you're an AI person now, Annie.
I think about AI all the time. And really, the sort of way I think about this is that if you think about lending, everybody should be concerned about bias in lending, no matter what system you're using, whether it's a human underwriter or a scorecard or a checklist or a logistic regression or an AI model. No matter what the system is, you should be concerned about bias in lending. And so when I think about this problem, I sort of break it down into there's 3 components of any sort of lending assessment. There's what goes into the assessment, there's the assessment itself, and then there's what comes out of the assessment. And so let me just sort of break down what I mean by that and sort of why there is risk in lending and fairness risk in lending. Right now, there's a sort of suite of what I'll call traditional variables that everybody uses to make lending decisions. Things like a credit score, things like a person's income, their debt to income ratio, et cetera. Everybody uses those to make their assessment. Those variables in and of themselves are not pristine from a fairness standpoint. When you think about something like, we know that women on average are paid less than men for the same job. If you're using their income, that's going to be a different assessment that's going in, on a protected class basis. Same things if you look at something like a credit score distribution. We know that in the full sort of spectrum of credit scores, the lower end of the spectrum tends to be more heavily populated with minority groups relative to the higher end of the spectrum. So if you're using that as one of your only inputs into the system, you're introducing the potential for bias, right? And so you really need to understand what that sort of effect is. And then the second part of the puzzle is the actual decision making itself. Using a human example of a human underwriter, there's all kinds of assessments made in a human's brain and connections and previous biases and unconscious biases, et cetera, that are going into that assessment process that you don't always understand. But what you can understand from a compliance standpoint is the output, right? Testing the output. Was this person consistent in how they made their decision? Did similarly situated people get the same result, et cetera? And so really the beauty of an AI system is that rather than having 100 different human underwriter brains that you don't understand, you have one computerized brain that you can literally pull the curtains back and understand. You can look at what the assessments are. You can change the assessments if you don't like them. This brain itself can be trained to not use hard cutoffs like, credit score above X is good and below X is bad. This system can really understand more nuanced things relative to something like a checklist sort of model. And so that's why I believe that using AI in lending is actually the solution for these biases, as opposed to, it's not a new risk that's being introduced. the risk of bias in lending has been around as long as people have been lending, because of societal issues, because of, human brain power issues, et cetera. And I really think AI is actually the solution. And so the second part of your question is what to measure, and the answer to that is everything, in my opinion, right? And that's the compliance officer in me, right? When you can have all of the data and you can measure the data and you can look at what is the actual impact that this model has had, what decisions did it make, who did it approve, who did it decline, at what price, all of those types of things. Measuring those things on a consistent and ongoing basis is so critical to understanding how that computerized brain is working, so that you can constantly be tuning it to, advance your mission of reducing disparities in lending and improving access to credit in lending. And that's really, to me, the crux of what we're trying to do at Upstart.
There's a lot in there. It feels like in that analysis, the similarly situated person is doing a lot of work in terms of how you think about analyzing. How do you think about that? I mean, like, that's in a traditional model. How do you define what a similarly situated person is? Is that credit score oriented? That's that phrase has a lot. Are you treating similarly situated people the same? Assumes some sort of definition of similarly situated that makes sense.
Yeah, I mean, and that is the challenge. I think different institutions have different definitions of how they look at that. But what we see constantly in the data at Upstart, using the sort of more variables in using AI, is that most people are not similarly situated to other people, right? Everybody has a unique set of circumstances, a unique background, and what's true for me might not be true for you. And so having a really customized, personalized, tailored approach to understanding an individual's risk is the key to sort of improving the accuracy of the model, so that more people are approved for credit, as opposed to, again, just cut out because of some hard cutoff.
Well, I mean, traditional lenders, when I talk to them, and I'm always kind of hearing this approach talk about, compensating factors where that human judgment comes in. So that most of them, when I say this, they go, well, I mean, we don't use that hard cutoff. Really, there's like the hard cutoff, and then there's the ability for the human to make judgment about someone where there's some reason to think that a low credit score or a high debt to income is not, such an issue in this case. Talk about how you think about humans looking at other compensating factors in a credit file versus what an AI model is doing. Because it feels like, that would be the answer to, hey, you talk about hard cutoffs as the problem, but like, we have ways to get around that too in a non-AI driven system. Why do we need AI? So kind of compare and contrast how you think about that concept versus what's going on in a system like Upstart's.
Yeah, absolutely. I think for me, the big difference is compensating factor versus statistically rigorous compensating factor. Because when you introduce compensating factors into an underwriting decision, what you're really introducing is human discretion, and human discretion is fraught with the potential for bias. And so there's a lot of concern for me in terms of, who knew to ask for an underwriter to look at a compensating factor. That's going to potentially have differences across different protected classes. Who did the underwriter actually grant that to versus not? What do they think counts as a compensating factor based on their own set of experiences? There's just a lot of sort of room for judgment calls and discretion in that process that introduces a whole new sort of suite of fair lending risk, in my opinion. Whereas again, if you have it done by an AI model that is making a statistical assessment based on actual real data and mathematical approaches, then what you get is a consistently applied compensating factor where the model recognizes, okay, this thing 90% of the time is a good signal. So across every single application that I see with that particular set of circumstances, I'm going to see that as a good signal, as opposed to it being sort of applied one-off based on somebody knowing to ask for it or some other person knowing to look for it.
All right, Annie, I wanted to ask you about kind of fair lending laws, because I think this is a really important area of regulation and consumer protection. And, all lenders are subject to a variety of fair lending regulation, but as underwriting shifts both to become automated and then maybe more interestingly to become more sophisticated in the types of data it uses or the analytical techniques, do you think those fair lending laws are kind of up to the task? Are there revisions that are needed? How do you think about the state of those laws as the state of how we do underwriting changes?
Yeah, I think it's a good question. I think that the truth about the laws is they're very well written, and there's not a ton in them that probably a lot of people would disagree with from a conceptual standpoint, myself included. They're written intended to achieve exactly what we want, which is not to have discrimination in credit decisions and to avoid some of the easy pitfalls where that could be introduced. I think where there is a lot of opportunity for advancement is clarification of how those laws can apply to existing technologies and newer technologies, because there's a lot of concepts within those frameworks that reasonable people can disagree about. So when you think about something like a proxy, right, we can see through data that all variables are sort of correlated to other variables, and whether that is a strong correlation or a loose correlation, it really sort of changes. What is the level of correlation that makes something a proxy for a protected class versus not, is something that reasonable people can disagree on. I think also the application of how we do testing for fairness and what outcomes are good outcomes versus bad outcomes is another really interesting thing that needs some clarification. Right now, there's sort of existing framework where people have three parts of their analysis that they do. The first is to look and see whether there is evidence of differences in treatment amongst protected class. The second pillar would be to look for business justification of why that might exist. Is it to meet a legitimate business need? And then the third is for less discriminatory alternatives. And the breakdown that you see and how this is applied is that people have different approaches for how deep they're going to dig on something like confirming legitimate business need or confirming that there is no less discriminatory alternative. What's a reasonable amount of research and commitment and ongoing sort of model redevelopment that is suitable in those sort of searches? And so because those two pillars of legitimate business need and less discriminatory alternative are very challenging to solve, and if there's disagreement about what the right metrics are, a lot of people instead try to just manage to that upfront adverse impact ratio, the AIR metric that a lot of people use. And the problem there is we see just ongoing in the market some weird behaviors related to managing to that metric, since the other two are ill-defined. Things like limiting who you're marketing to or that type of stuff. And so when really the purpose of the spirit of the law is to get people access to credit that they need in fair and affordable ways, a lot of times the way that those laws are actually applied in institutions is almost counter to that policy objective, because people don't know exactly how to achieve that in the sort of existing framework. So one of the things that I'm actually super excited about, Upstart recently launched and announced a new coalition, which is really designed to sort of tackle this problem of bringing together a lot of different voices to the table to share transparently best practices and thoughts about some of these difficult issues. I mentioned before on some of these things, reasonable minds can disagree, but everybody's got a really valid perspective and point of view here. So bringing together industry, regulators, special interest groups, et cetera, to the conversation to talk about what are the issues, how do we resolve for them, what are best practices, I think is a really important and valuable opportunity that can really move the needle in terms of advancing some of these conversations and hopefully providing, a framework for the broader, industry ecosystem, as well as regulators and policymakers, about how we think about these types of things in the future.
That's the more than fair is what you're talking about, right?
That's right. More than fair.
Where do people find more information about more than fair?
So actually, we just launched our website, morethanfair.org, I believe, yesterday. And we also have a blog post up that you can read more about it as well.
Awesome. And I think the name just begs the question, what does it mean to be more than fair? Why is fair maybe an insufficient? I mean, that seems to imply that fair is not a sufficient, maybe a useful test, but not a sufficient test for if we as an industry are doing all that we should to help disadvantaged or marginalized, traditionally underserved communities. What is it that the coalition thinks is important that's more than being fair?
Yeah, I think the primary problem is the sort of if you're just talking about fairness or parity, what you don't talk about is inclusion or access. And so that is a big problem in the ecosystem today. People can achieve parity in terms of outcomes and decisions amongst two groups by saying, I'm only going to lend to the prime end of this spectrum. I'm only going to market to them. So everybody that I market to is approved. And, there's parity in my outcomes. But what happens when you do that is the subprime end of the spectrum, which ends up, because of our sort of societal inequities, being heavily towards immigrants and people of color, those are the people that are then left out by that system. So on its surface, it might look fair, but it's actually not inclusive. And it's again, not solving the sort of actual societal need that we have to really revolutionize how we think about getting people access to credit, so that when somebody needs a small dollar loan to change their tires so that they can get to work, or they need a mortgage, or they need an auto loan, that they have the access available to them at the time that they need it, so that they can keep their life moving.
That's interesting. Yeah, I think it's not always intuitive to people that the idea of fairness can run counter to the idea of inclusion. But I think that's a really interesting element. I think that's the same one you were talking about in terms of how testing for fair lending and how we need to think about approaching this. Because I think as you and I have talked in the past, there can be penalties for people trying to be inclusive in terms of the measurements we might think of on a fair lending point of view. And that seems to be not the intention of the law, but the reality of the application of the law, what you're talking about clarifying.
Yeah, absolutely. I agree with that.
Oh, good. I like when people agree with me, because I must have learned something in the conversation so I can speak intelligently about a topic. Awesome. Well, that's all the stuff we wanted to cover today, but I do have 3 final questions that I ask every lucky participant as a guest on the podcast. So I'm going to throw them at you now, and then you can get on with your day. The first one is, what's the best piece of career advice you've ever gotten?
So I actually tell this story to a lot of people that I interview and a lot of people that work for me. And it's the story of one of my first interviews when I was starting out my career in financial services. I sat down with the interviewer and I asked what I thought was the appropriate question, which is, if I get this job, what is the next step for me if I grow? And the response I got was completely not one that I expected. The person sort of sat back in their chair and they said, hey, if I have to hold your hand, this isn't the right job for you. You're going to just go as far as your own ambition carries you. And I think it was really good advice, especially for, a young woman starting out in financial services, which is primarily an industry dominated by older men, or at least older than I was at the time, men, of just being willing to raise your hand and sign up for more things and believe in yourself and say, hey, let me try that. Let me show that I can be capable of learning that thing. And so getting the sort of runway from a mentor that, just show up and do what you solve the problems you think need to be solved, I think was really good career advice.
I love that. And empowering people with the confidence to follow their own ambitions and intelligence and thoughts and ideas and to put those forward, I think is so important, because it can be tough to do, particularly early in your career, to have that confidence to go, I'm going to disagree with the boss because I think they're wrong and I know more. And that's not always comfortable. Even for me today, I still find that. So good advice for everybody. Second question, what's the best advice you've gotten about the consumer banking or consumer lending space?
So I'm going to tell you like a silly little story, and really it's a story about status quo bias, which I think is a big problem in consumer lending and in financial services generally. So this also came from a former colleague that I used to work with, and she would always say, don't cut the ends off the roast. And I would say, what are you talking about? What does that even mean? How does this apply to my life? And she would tell this story about, some person goes to cook a roast and they cut the ends off and their child asks, why do we do that? And the person says, well, my mom taught me to do it this way. So they go to the grandmother and say, why do you do that? And she says, well, I don't know. My mom taught me to do it this way. So they go to the grandmother and say, why do we do this? And the grandmother said, I don't know why you do it. I did it because my pan was too small. And I think that that's a lot of times what happens in financial services is there's things we've been doing for a long time. And so we have this status quo bias that's seeped in where we think that just because it's been done that way for a long time, it's good or it's right or it's the best. And maybe that's not true anymore, right? And so being willing to ask that question 100 times, is this still the right thing? Is it the best thing? Is there some alternative approach that we can be taking to this problem that would solve the problem in a better way? I think is something that we all need to be doing, especially in an industry as important as banking, and important, I mean, to the consumers that we all serve.
I think it's a fascinating story and so true. And always, so one of the advice I got that I think is related is, be willing to ask a stupid question. Like, probably nobody wants to ask, why do we cut the ends off the roast? Because you can go like, you don't understand. Like, you're going to feel like you're the one person in the room who doesn't know. And the number of times I've asked a stupid question and then I get an email or it's like, I'm so glad you asked that. I didn't know either. I thought I was the only one who didn't know, and I was out of the loop. And it turns out like there's no answer to the question, or we don't know, and nobody's thought about it. It happens so often, so it's great. Don't cut the ends off the roast, or at least ask why we're cutting the ends.
At least ask why. Yeah, and I say this to my staff all the time. My own staff, I say, please don't ever do anything that you don't know why you're doing it. If you don't know why you're doing it, stop and ask me why. Because you're going to just do it better if you understand that context, or you're going to come back to me and say, I have a better solution to solve that problem. And so that's the advice I always give to my staff today.
I like that just as much. And I could, well, it's not as memorable as don't cut the ends off the roast, but maybe more immediately applicable because I don't cook a lot of roasts myself. All right, my last question, one bold prediction for the future. What do you have for me?
Yeah, I think my bold prediction for the future is, I'm a huge history buff, as you probably know about me since we've been friends for a long time. But as we look through history, we see just time and time examples of things where we had some big advancement in society or culture. And always in that time, there's naysayers who think it's too risky, or, we shouldn't be doing it. It's not the right move. And so I think in some ways the same thing sort of is happening a little bit now with AI. There's a lot of people who are afraid of machine learning and about artificial intelligence and the risks that it poses for the future. And I think if you over-index at looking at the risks, you don't also look at the benefits. And so what really should be happening is a conversation about both. How do we harness the benefits while mitigating the risks? So my bold prediction is that AI and machine learning in underwriting is going to help us solve some of these societal inequities that we have, because I think starting with getting people access to credit is a really important starting point in solving some of the broader sort of inequality problems that we have. I think that we have a potential for solution in AI and ML if people really adopt it. And so that's sort of what I'm hoping that we see materialize over the next short period of time here, because I think we have the technology, and now the rest of us need to just catch up to being comfortable using it and allowing it to help solve the problems, again, while appropriately mitigating any associated risks with it.
I like that bold prediction. It's both positive for the industry, but also for the American public and the consumer in terms of enabling access. Well, thank you for taking the time today, Annie. I appreciate your thoughts. And for those interested in learning more about More Than Fair, you can find us at morethanfair.com. So go check it out and you can read up more on these topics.
Thanks, Jeff.